welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
Well, I think what the data shows us today is that the Fed does not need to be in any rush. So I think anybody who expects a rate cut at the July meeting, I think that's completely off the table. And I think it even may put September in question. Let's keep in mind, though, that we still have a lot of data to get through before we get to that September meeting. But I think it gives the Fed that flexibility to say, hey, things are slowing, but they're still okay.
So chips have had such an incredible run over the past year that any hiccup, any rumor of something is setting the stocks going a lot lower, even those that are tied directly to AI infrastructure.
Prepare for a bloodbath for the rest of the year. What we're missing here, despite the doggerel put out by American Airlines, the fact of the matter is we have higher labor costs coming into play right now, and now we have a very desperate ULCC sector, which used to be somewhat separate. And American, Delta, United, Southwest, they're going to have to react to it.
We got 1 hour to go until the market close, so let's take a look at the major averages. Now, early in the day, out the gate, we did have sort of this bounce back happening in today's session. That's not so much the case anymore. The Dow is still higher, but it's come down off the highs, up about 236 points, about 0.5%. The S&P, very little change to the upside. It's come almost all the way back down again. And the Nasdaq has now dipped into the negative after that rebound that happened earlier in the session. Now, just taking a little bit of a tour around, Josh, and what we're seeing, because we did have last quarter GDP numbers this morning that came in better than estimated, but so did inflation numbers as part of that. Now, that's backward looking. The market doesn't react that much to it, but it's still a topic of conversation. The Russell 2000 outperforming today. And even with that data this morning, we've got rates that are pulling back a little bit today, down 3 basis points. 4.26% is where we see.
I mean, it sort of just feels like investors trying to just figure out the trade and what comes next. I mean, you had that significant sell-off. You had the first big tech names report. Alphabet reported underwhelmed. Tesla reported underwhelmed. It brought out just bigger questions about the AI trade and theme. Yeah. You got other big tech names now on deck. We spoke to Doug Clinton on the show and what he expects. I think he used the word choppy. Yeah. Right. So you're just trying to figure out what could come next. I think the small caps also good flag there. That's a really interesting move, outperforming again.
Yeah. Well, things are choppy again today for sure amongst big tech. We did see more of a rebound effect. Now some of those stocks are coming down. And just to point out, something that I pointed out sort of earlier in the earnings season is that, listen, when it's earnings season, sometimes you don't get big macro moves. You get individual moves, with Ford down 18%. Just to give one example, a lot of companies reacting to their individual numbers, and there's not necessarily a big narrative uniting them in all cases.
Did you think that GDP move was kind of interesting too? Your point is well taken, backward looking, but there had been sort of, I didn't hear anybody's base case, but there was sort of those whispers about July for the Fed. Yeah. And whether you think that just kind of takes that off the table now.
I did see a lot of notes to that effect. We'll see if it does. All right, let's talk more about the markets today and more broadly. For more on these moves, I want to welcome in Savita Subramanian. She's BofA Securities head of both U.S. equity strategy and U.S. quantitative strategy. Savita, it's great to see you.
Great to be here. Thanks.
So I want to talk a little bit about how you're thinking about this sort of choppiness that we're seeing in the markets, but also how it relates to what you expect longer term. Because I know your year-end target for the S&P is still around 5,400. We're above that now, but does that imply you see more downside from here?
Yeah. So, I think the idea is from here through end of year, we're not necessarily going to see this smooth sail straight higher like what we've enjoyed for the first half. I think it gets harder in particular for technology companies, for mega cap tech, because really here we're starting to see these companies price in much loftier expectations. Last year was a different story. Mega cap tech, nobody was expecting anything great. These companies cut CapEx, they cut costs, they, downsized their workforces. They did everything like from a self-help angle. And then on top of that, we got this big AI surprise. This year, it's, these are companies that are spending a lot of money. CapEx is back on the table for mega cap tech. So they're cutting into their free cash flow generation. They're not necessarily in cost cutting mode. In fact, they're in spend and grow mode. There's a little bit of an arms race for everybody to spend on AI just to keep up with the Joneses. And I think that's pushing expectations driven multiples. These are high multiples that are now at risk of disappointing. And we saw a little bit of that yesterday. I think it's interesting, as you pointed out, that the Dow and the industrials are holding up better than the rest of the market. And that's our call for the rest of the year, is kind of stick with old school, economically sensitive areas of the market. Because here's the deal. Even though we've only focused on CapEx in chips and, kind of semis, there are a lot of other areas where we expect to see broader scale, long-lived CapEx. And I think one of the most interesting themes in the S&P 500 right now is looking at the fact that regardless of who wins the election, which is the big event in November, we are likely to see support from both sides of the aisle when it comes to moving IP out of China back to the U.S., moving jobs to the U.S., moving manufacturing to the U.S. That has already happened. And what's interesting is that we've seen, half of the economic activity that used to take place between the U.S. and China overseas is now taking place on the ground in the U.S. And that is taxing the already somewhat frail infrastructure in the U.S. So, one of the notes that we wrote recently was the idea that forget about AI and chips, focus on old school CapEx, because this is an area where you really need to beef up the infrastructure in the United States in order to handle all that extra economic activity that nearshoring and reshoring has driven, as well as just firing up the semis and the chips that we need to, keep this AI story going. So I think it's time to move from expensive, crowded technology stocks to less expensive, less crowded industrials, machinery, metals and mining, oil, even fossil fuels could benefit from a good old-fashioned traditional manufacturing CapEx cycle. And we haven't had one for a long time.
Savita, this is such an interesting point, and I love that note that you guys put out about this whole phenomenon. And one of the charts from the note stood out to me, which had to do with construction spending on U.S. manufacturing and just the huge surge that we've seen there. Of course, as you point out, some of this has had to do with government programs, with the CHIPS Act, with the IRA, and sort of trying to spur some of that activity. Why are you confident that this is sort of an administration agnostic phenomenon and that it's going to continue no matter what?
Good question. So I think the idea here is, if you look at actual CapEx spent over the last couple of years, as well as CapEx being planned to be spent over the next 5 to 10 years, a tiny, tiny fraction of it is fiscal stimulus. The rest of it is companies spending on either themselves, tech spending on tech, but also tech spending on, building out data centers and lumber. And it's also about, fixing highways. And these are areas where, the muni market hasn't really gotten bigger in a very long time. It has just sort of flatlined in terms of its size. But I think the idea is, if cities want to court all of these new businesses and new jobs and economic activity, they need to make sure they have the infrastructure in place to support that. And I think that is necessitating and maybe hastening an infrastructure spending cycle that is, kind of, as you put it, agnostic of who wins the election, government spending, fiscal spending. It's interesting because we have another chart in that same note where we show that fiscal spend is something like, less than 1/10 of overall spending that's slated to happen over the next 10 years. So even a clawback in fiscal spending wouldn't kill the story. It would be, a minor hit, but it wouldn't necessarily crush the story.
Savita, switching gears, another theme investors are certainly talking about, small caps. They're in the green and outperforming again today. Savita, your thoughts there?
Yeah, small caps is tricky. And I think that, the Russell 2000 looks cheap. It looks like it could do well in a more domestically driven economic cycle, like what I'm alluding to. The problem is the Russell is not just, kind of the small domestic plays and the nascent growth stocks that are about to grow up into big cap companies, small caps have really changed to a much a trickier benchmark. So the problem is that a lot of small companies are former large cap companies that drifted into the Russell over the last couple of years because they can't hack higher interest rates. So our view here is, okay, unless we start to see the Fed really tell us short rates are at peak levels, we are going to cut. In fact, we are cutting interest rates. So I think it's almost like you need to see that first rate cut in order to buy that entire index wholesale, because there are a lot of companies in the smaller cap benchmark that have floating rate risk, that have refinancing risk. Commercial real estate is much more prevalent in the small benchmark than in the large benchmark. Regional banks are still working out a lot of their lending that they've done over the last 10 years, assuming much lower interest rates than what we're experiencing today. So those are areas that I would worry about. I think that there are big pockets of the small cap benchmark that look attractive, but not the broader index overall. And the problem, again, I'll cite a statistic for you that makes me a little bit nervous. Over a third of the Russell 2000 growth benchmark just doesn't make any money. And that is a record high. And I think that is the problem, is that a lot of these companies are really just companies that survived in a zero interest rate environment, but aren't going to hack it in a 5% or even 3% interest rate environment if that's the run rate from here.
Right, because of course, even as the Fed begins to cut, the rates are still going to be higher than they were in the zero interest rate environment. But speaking about cuts, Savita, I am curious what your thinking is in terms of timing from the Fed, and not just timing, but how long those rate cuts are going to last, where they're going to end up, and then the interplay between that and equity markets.
Yeah, so I think the idea that that the Fed is going to be cutting demonstrably this year is still up for grabs. We're data watchers just like everybody else. I think the idea here is we're probably close to peak on short rates, and the next move in terms of the Fed funds target rate is likely to be a cut rather than a raise. So that's good. When that happens, probably towards the end of the year, I think our economists are forecasting that the first rate cut happens in December. We got one this year and then a few more next year. The terminal Fed funds rate is around 3.5%, but that takes a couple of years to get to. And in that backdrop, I don't worry about large caps, because I think larger companies learned their lessons from the financial crisis. These companies, especially, some of the more cyclical areas like financials, energy, industrials, these companies took advantage of low interest rates and locked in low fixed rate debt obligation. Big banks haven't been allowed to lend, so they've been much higher quality over the last 10 years than maybe the regionals and smaller banks. So even if, rates just kind of creep a little bit lower from here, I think we're in an environment where large caps actually S&P 500 looks pretty well positioned. On top of that, you've got tech companies that are net cash positive. So despite this little mega cap tech hiccup, there are a lot of advantages that tech companies have, just relative to the broader benchmark. And one of them is having cash and returning that cash. So I'm excited about the S&P 500 over the next 5 to 10 years, not necessarily from a multiple expansion perspective, but from the perspective of inflation protected income for all those retirees that have parked their money in short duration bonds or money market accounts. Those investors would be well served moving back into equity income if the Fed does start cutting rates demonstrably, because these are folks that need stocks that they can live off of. They need investments that offer a real rate of return. And that's where I think that large cap companies offer a really significant advantage versus bonds and other fixed income opportunities out there.
Savita, what a pleasure to see you, and so many ideas
Likewise.
For people who are watching. Thanks so much. Really appreciate your time.
Thank you. Thanks for having me.
OpenAI is getting in on the search game. The company today unveiling Search GPT. The AI-powered search engine gives users answers with links to sources from the internet. Currently, Search GPT is only a prototype. The company says it has plans to integrate the features into Chat GPT in the future. Shares of Google parent Alphabet plunging near recession lows on that headline. So they're getting into the search game. They are partnering with publishers and creators. I thought it was interesting how they emphasized that on the blog. Julie, you can join the wait list. I don't know if you want to.
I joined. I already
You're
joined it.
like, you were always a step ahead of me. It is early days. I mean, this is a prototype. We have to see how it evolves. I'm going to wait for Howley's review here. How smart, how effective, how useful is it?
Well, what's interesting is in their blog posting announcing this, they said getting answers on the web can take a lot of effort, often requiring multiple attempts to get relevant results. Has that been your experience? Sort of, maybe.
It could always be better.
I guess. I don't know. So to your point, we'll see if they. I mean, okay, so do better then. That's what the challenge sort of is to them.
And if it, we'll see what Howley says. But if it is better, and then you're Sam Altman, then also it'll be really interesting. How does he think about scaling it?
Yeah,
right? So
scaling it, making money from it, all the rest. All right, we're just getting started here on Market Domination. Coming up, shares of Royal Caribbean under pressure today despite a strong earnings report. We'll be joined by the cruise liner CFO on the other side. And at 3:30, it's the latest edition of our series Goodbye or Goodbye. We'll break down 2 stocks to help you make the right moves for your portfolio. All that and more when Market Domination continues.
Royal Caribbean reporting better than expected second quarter results and seeing strong demand, raising its outlook. Cruise giant also reinstating its dividend. Despite that good news, you can see the stock slipping here. One thing that may be weighing on investors, an expected increase in annual costs. Joining us now to walk through all this, Royal Caribbean CFO Naftali Holtz. Naftali, it's always good to see you. So you look through this report, you boosted adjusted EPS guidance for the year. That beat estimates. I do see some commentary that perhaps higher than expected costs could be creating some concern. But Naftali, let's start with your read. Give us your take on the quarter.
Yeah, first of all, great to be here, and thank you for having me. We are very happy with our results today, or with our focus on performance. We beat the second quarter. We raised outlook for the rest of the year. We achieved our financial targets 18 months earlier. Our balance sheet in a very strong position, and we reinstated the dividend. So our focus on delivering the best vacations in the world and great financial performance is really our focus. As regards to your question around the costs, we did raise our costs by 50 basis points, but that is entirely due to stock-based compensation, which is non-cash. And that is really because of the share appreciation that happened in the quarter that weighs on our costs. But our formula remains the same. Moderately grow the business, moderately grow yields, and very much strong controls, cost controls to make sure that we enhance margins, and that drives shareholder returns.
And Naftali, talk to me about pricing and what you're seeing on that front, and pricing versus sort of volume of folks, traffic on the ships here, how that's looking going into the rest of the year.
Yeah, so really demand has continued to be very, very strong. We've been seeing it consistently quarter over quarter now. Our second quarter beat was really driven by strong pricing, and that's really because we put the right experiences in front of customers, and they're really thirsting for that experience, and really that's drive the pricing. Going forward, really our occupancy levels are really back to normalized level. So all our increased guidance and really the strength we're seeing is about the pricing. And again, putting the right experiences on the ships, private destinations, on board, and really having the right commercial apparatus. It's what's driving us to bring more people to our ecosystem, really getting into the vacation and staying there and coming back to us again and again.
Naftali, you did decide to restart dividends. How come, Naftali, and why now?
Yeah, so as I said before, when 2 years ago we had a financial program that really was focused on getting us back to what we call base camp, and really focusing on making sure that we recover our margins and really strengthen the balance sheet. And today we've achieved that. We've achieved trifecta. That's our financial program. 18 months earlier, our leverage now is below 3.5 times, way within the target leverage that we have for the company. And that would allow us to really expand our capital allocation, and dividend is kind of the first step for that. And if you think about it historically, we always had a balanced capital allocation. We see a lot of growth in the company, so we want to continue to invest in the company, but also with the excess cash flow, we want to also return it to shareholders, and that's the first step today.
Naftali, I have to say, I mean, the numbers looked pretty good. You sound quite optimistic, and yet the stock is down. And I'm just curious if you're hearing anything from investors today or from the analysts who track the stock that shows what they're concerned about.
Yeah, I think we're all trying to understand a little bit what it is, but honestly, we're just focused on performance, putting the right experience on of people and the customers, making sure we're delivering that with strong financial performance is really what we believe we first control, but also will drive shareholder return. So, you know, we are normalizing the pricing, right, and the yields, and that's because, you know, our occupancy levels are back to normal. But we're very excited about the future, and honestly, we're just starting. Really, everything that I talked about is getting us to base camp. But if we kind of look at the bigger picture, cruise is a $65 billion category in a $1.9 trillion vacation market. We think we have a great opportunity to continue to win share with the consumer and do it for the next several years. And so for that, we're very excited. And we're going to do that with our proven formula. Modestly grow our fleet, modestly grow our yield, and very strong cost control to enhance margin and really drive shareholder return.
Naftali, great to see you. Thanks so much for joining us to talk us through the quarter. Appreciate it.
Thank you.
Let's get to some trending tickers now, besides RCL, that is. Let's lead off with Honeywell here. Those shares are falling after the company reported second quarter earnings. It also raised its full year sales outlook, but cut its earnings guidance. There seems to be some disappointing stuff here. Also, the profit guidance for the third quarter was below what analysts had been anticipating here. Sales growth has been picking up a little bit for the company. Vimal Kapur, who is the CEO, did talk about aerospace leading growth at Honeywell. But the other parts of the portfolio are also doing well, but investors not pleased with that forecast, sounds like.
Yeah, it was just interesting to kind of look at what bulls are saying today. Citi, for example, telling clients, Q2 results, they looked over the report, thought it was solid. Yes, they said guidance, they could weigh on stock in the near term here, and you certainly see that today, we're down about 5%. They were arguing they expect earnings growth and stock price appreciation in the long term. They still see that due to improving end markets. They call it disciplined execution. So optimistic take there, but obviously some investors, at least today, have some worries.
Yeah, and remember we were talking about destocking and the destocking cycle recently. I also saw some commentary that perhaps that's an issue, that there's still some destocking going on. In other words, if I've got a bunch of stuff in my warehouse or wherever it is that I'm ordering from, that I'm storing it, maybe I'm not that eager to order new stuff. And there's been some talk that destocking cycle, as we talked about yesterday, Bank of America's Oh-Sung Kwan saying the destocking cycle may be coming to an end. But of course, it's not going to be the same for every company. That's it. All right, moving on. She got another one here. RTX shares ripping higher right now after the company posted better than expected Q2 earnings. The company also lifting its full year guidance. So RTX, maker of jet engines, Patriot missile defense systems, second quarter results beat expectations. They raised the full year forecast for adjusted earnings. Sounds like they did lower their forecast for free cash flow, but reading through reports, they noted that this is because of the expected resolution of legacy legal matters, among other reasons. Relatively new CEO here, Julie. Chris Callio took over in May from longtime CEO Greg Hayes, who is still executive chairman. Company has been making some moves with its portfolio, looking to reduce debt, and a nice run for the stock. Yeah, it's up 36% so far this year, including the gains that we're seeing here today with the strength of defense, which is, we've been, Lockheed Martin the other day also coming out, I believe, and beating estimates. So now a little bit of a trend here among the defense companies. And finally, we're also looking at waste management shares. They are sliding after the company missed second quarter earnings estimates here. The company also reported EBITDA that missed estimates here. And so there's some questions here around, again, perhaps it's a trend. We heard from Waste Connections, a big Canadian waste management company, also came out with disappointing numbers here. The company had raised its 2024 guidance last quarter, and so now coming out and missing. Bloomberg Intelligence says there are questions about visibility in terms of the earnings trajectory from here. Yeah, that was an interesting note. So the company is sounding very confident, right? They're talking about a strong performance in the first half. Confident, they told investors, they're on track to meet or exceed the midpoint of the full year financial outlook that they provided a few months back in April. I did think that note you mentioned from the analyst at Bloomberg was interesting, because their argument was this print and miss just one quarter after raising 2024 guidance raises questions, they said, about visibility in a business that had been characterized by stability. So that certainly gets noticed. Obviously, some investors are hitting the sell button today. Yeah. All right, coming up, it's that time, the latest edition of our series, Goodbye or Goodbye. We're joined by a portfolio manager to take a deeper dive into two stocks to help you make the right moves to your money. Stick around, much more market domination still to come.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action.
And explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. We're taking a look at two stocks with exposure to interest rates. They've been on a bit of a ride over the past year, so what's the best way to play it now? I'm here with Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. It is great to see you.
Great to see you, Jules.
So let's get to the stock that you're recommending folks buy. It is Builders First Source.
Yeah,
so this is
love it.
a provider of stuff that goes into homes here. And indeed, you can see the kind of wild ride that the stock has been on over the past year. So let's get to why you like it. There is indeed a shortage of housing.
There is a housing shortage, and it's a big one. By some estimates, as many as 5 or 6 million units. And that is a number that has been confirmed probably by 3 or 4 other independent operators. That number is from Freddie Mac, the 5 or 6 million. And it's because you know, back in 2008, they were building too many houses, and we're still sort of suffering from that muscle memory. So housing shortage creates the argument that you're going to have prices moving up. And if you're talking about a company that supplies to builders, you know, that's good for them. You need to build more houses. That's point number one. Point number two, bring that up, mortgage rates are likely to come down. So if you've got inherent demand because there aren't enough houses out there, and you have mortgage rates coming down so you can actually start to afford houses, again, it reinforces the argument that you want to be long building type companies. You want to be in the housing sector. You want to have exposure to the housing sector. And then point number three, the stock is cheap. It's really simple. Trading at about 10 or 11 times earnings. Now, the earnings are down this year because we're just not seeing the housing demand that we've seen in the past. But I think that's starting to turn. And if you listen to what management is saying, they're actually guiding for 15 to 20% growth next year because they're already seeing forward orders for next year in anticipation of what we're talking about. The housing shortage, building more houses, and rates coming down, creating demand.
Right, and it's been an interesting picture among the builders themselves, right? Because mortgage rates have been high, they've had to offer incentives to get the houses, but they're still building the houses. They're still buying stuff to go from places like builders to put into the house.
Well, and as a matter of fact, if you listen to what management at Toll Brothers said on their recent call, they are selling out faster than expected, and they're starting to build more spec houses just to meet demand, which is fascinating because, you know, for the past couple of quarters, there hasn't been the demand, but people are already starting to come in and buy.
So we always talk about what the potential risk is. In this case, it's that, well, you don't have either the economy stagnates and buyers don't materialize, or it just gets pushed out further, I suppose.
Yeah, that's right. You know, there's this notion that, well, wait a minute, maybe we're going to go into recession. I don't think we are, and we saw that strong GDP report this morning, 2.8% growth. So I don't think that that's an issue, but it's always out there. You know, or if inflation were to reaccelerate and the Fed had to actually go the other way and raise rates again, that would certainly be a negative. But again, I don't see that as an issue. I really don't.
Yeah, that seems like a pretty out there.
I think so. So I'm very comfortable owning this stock, and especially given the valuation, 10, 11, 12 times earnings.
And you do own the stock.
Oh yeah, I own it, so do my clients.
Gotcha. All right, let's get to the stock you say folks should avoid. That is Charles Schwab. Charles Schwab, too, has been all over the map. I mean, I think this drop here was the one after its latest earnings report, which was disappointing. You say it's dead money. Now, for people who don't know what that means, explain what that means.
So dead money means you're not making any money. It's just sideways. And while if you look at that chart, it appears like it's up and down. The fact is the all-time highs were 2.5 years ago. So in other words, for 2.5 years, the stock has been, in fact, dead money. You have not gotten back to the old highs. The rest of the market is making new highs, but Charles Schwab is not. So dead money. You gotta, you want to put money to work, and this doesn't seem to be working.
Well, and it's interesting because Charles Schwab got kind of caught up in the regional banking crisis, but even if you could look back further and you look at the earnings, it's the past 6 quarters that before that happened, that earnings have been declining.
So, truth be told, in full disclosure, I was along this, both for myself and for clients. And it's because earnings just can't seem to get jump-started. Earnings declines for 6 quarters in a row. They bought TD Ameritrade. I thought, I'm going to buy this because they're buying TD Ameritrade, bringing whole new customers. That's accretive to earnings. Nope, hasn't materialized yet. And so I actually sold it for these reasons. Dead money, consecutive earnings declines, and point number 3, I keep waiting for the turn, but it hasn't happened. $6.1 trillion of capital is sitting on the sidelines, not being put to work by Charles Schwab clients, but instead in government bonds. It's just parked on the side. I keep waiting for that money to come in, right, and propel the market higher. And that may happen, but again, how long do you want to wait for that to happen at Charles Schwab? I don't. I just think it's dead money.
You're done waiting.
I'm done waiting.
Okay, so
I'm over it.
We talked about what could go wrong with Builders First Source. Let's talk about what could go right for Schwab.
Sure.
Maybe that $6 trillion on the sidelines finally says, okay, I'm not as tempted by my 5.5% I'm getting on my CD or whatever it is.
Right.
I'm going to put it back into stocks, and I'm going to put it in with Schwab in particular.
Yeah, exactly right. And I call this a market rally that basically rises, brings all the boats with it, right? The rising tide lifts all boats. The theory being, yes, that money comes back in. It not only finds its way into Schwab brokerage accounts, but people just look at Schwab and say, hang on, it's been down for so long, it's got to go up at some point. And if the market's going up, Schwab would be a logical beneficiary of that. So I think that's your risk, but that's kind of nebulous, and it's a bit of a reach. And if they haven't been able to get there yet, again, that's why I sold the stock. I got tired of waiting, Julie. There are other things to buy.
Yeah, exactly. It's a whole big market out there, as we like to say.
That's right.
All right. Thank you so much for being here, Adam. I appreciate it. So Builders First Source, buy that one. Avoid Charles Schwab. Thanks for coming in. Appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
All right, checking in on some of our top calls of the day. A pair of cuts has shares of Lululemon sinking. Citigroup downgrading the apparel maker to neutral from buy, slashing its target to 300. JP Morgan, meanwhile, removes the stock from its analyst focus list and cuts its price target to 338. Yikes, Julie, the stock dropping to its lowest level in about 4 years. The news is the company says it's halting sales of a product line, Breeze Through Yoga Wear. I am not familiar with that, Julie, if I'm being totally honest, but they are pausing sales to, quote, make any adjustments necessary to deliver the best possible product experience, is what they told Bloomberg in a statement, and analysts are reacting, and so are investors.
I love talking about Lululemon, full disclosure. I'm a Lululemon product owner, right? But I also just find it a really fascinating company here. And indeed, you could be forgiven for not knowing what Breeze Through is, because apparently it just came on the market like July 9th. And then they yanked it real quick. But the commentary around why they yanked it, according to Matt Boss over at JP Morgan, the commentary around it I love. There was a back seam in the shape of a V, which customers cited as unflattering, giving them a long butt. Is one of the examples of what happened here. And the note actually has pictures of what the phenomenon was, but I'll leave you to look online and see what that's all about. And Citigroup also downgraded the stock to from buy to neutral. They cited less the specific breeze-through concerns and just more generally sort of lack of innovation, that the active apparel category overall is worsening, and then Lulu specifically is not giving, for example, the color assortment that customers want. So they out and out downgraded the stock to neutral here.
Stock is now cratered about 50% this year. Companies expect to report results in late August, so we'll see what we get then.
Yes, we will.
All right, another retail stock we are watching closely. Ulta, the beauty retailer, extending declines from yesterday. That was after Piper Sandler downgraded the stock to neutral from overweight. And joining us now is the analyst behind that very call, Corrine Wolfmeyer, Piper Sandler's senior research analyst. Corrine, it is good to see you. So you downgrade Ulta to neutral. You took the target to 404. Corrine, it looks like this really comes kind of down to your analysis of just kind of the competitive and promotional state of the business, Corrine.
Exactly. It's what we've seen with the promos. They've really picked up. They've become a lot more broad-based, and we do think it's a reaction to the competitive intensity we've seen over the past several months and even years, both from brick and mortar retail peers such as Sephora, that's really ramped up its store count with its partnership with Kohl's, but also with online players like Amazon, that's really ramped up its prestige beauty offering and seen a lot more brands feel comfortable selling on digital platforms like Amazon. It really is adding a bit of pressure to Ulta. And what we fear now is investor expectations may be, misaligned, and there's a lot less confidence in the margin opportunity going forward. And so we do think there is a lot of risk here, both from the top line and a margin perspective. And now investors are confused and not sure, what kind of valuation does this company deliver given all of these new pressure points that are coming into play.
Corrine, I'm curious, when you look at Ulta versus those competitors that you mentioned, whether it's Sephora or Amazon or others, why is Ulta particularly vulnerable here? Does it have to do with price? Does it have to do with experience? What do you think is going on there?
I do think Amazon's a threat to everybody. And as we put out earlier this week, the product offering that Amazon has, it does have heavy overlap with both Ulta and Sephora. Now, for Ulta, though, it also has a mass offering, which Amazon does offer. So there's always that overlap there. Sephora doesn't have that mass offering that Ulta has. But also at the same time, its main competitor, Sephora, it may be losing some share to Amazon, but it's gaining share from Ulta because of this heavy store rollout, whereas Ulta is losing share to both. It doesn't have that protective share capture from anybody else.
Corrine, who is the Ulta customer? What's the demo here, and how does that sort of compare and contrast to the competition?
The demographic, it's pretty broad-based. You have everywhere from Gen Alpha to baby boomers. You have people in all income groups, whereas some of its competitors are a little bit more specific as to which age group or which income level they cater to. So really Ulta is actually fairly well positioned in terms of its customer base. But what we're seeing now is customers across the board, no matter what age group, no matter what income level, they're diversifying where they're shopping. And they want to shop at all the different retailers. They don't want to stay loyal to just one.
Corrine, I'm curious what the read-through is for some of the other beauty-type companies that you cover, right? I mean, I guess they're sort of venue or vendor agnostic. I'm looking at the likes of Estee Lauder and e.l.f. that you cover, Coty. Sort of when you look at that bigger makeup landscape, are they being affected by what's going on at the sellers?
To an extent, I do think if a brand doesn't have exposure to the retailers or the areas that are gaining share, then they are going to lose. Fortunately, for a lot of the companies I cover and I look at, they do have broad-based exposure, and they do sell in a pretty diversified manner. And we're even seeing them start to shift where they're offering their products and putting more of their products in those high growth avenues like Amazon. A good example is Estee Lauder, that even just this morning they announced another brand is going on to Amazon. That's a very new thing we're seeing. So we're seeing the brands shift where they're selling and really going after where those high growth categories and distributors are.
Corrine, we mentioned e.l.f. You do like that name. You got an overweight there. Stock's had a nice run already. Corrine, why is that name still a buy in your opinion?
e.l.f. it's at a high valuation. It's reached very high, unprecedented growth. The margins are strong. So why do we still like it now? It really comes down to all the white space potential we really still see. And that's both in the US and in international markets. The main thing we really like here and we think is getting underappreciated by investors right now is that international opportunity that's rolling out rapidly. at Elf, but also the way they capture their consumer is so unique. And as I touched on earlier, the consumer is becoming less loyal. And so they need that newness. They need something constantly innovating and hitting them and really targeting them through all facets of marketing tactics. And that's what Elf does. They have very heavy innovation. They have very agile marketing strategies. They're always experimenting. They're always trying out different things. And so the way they've been able to capture and lock in that consumer is very unique to what we've seen in the rest of beauty.
Interesting stuff. Corinne, thanks so much. Appreciate it.
Thanks for having me.
Coming up, the streaming wars are lighting up between new NBA streaming rights and a new bundle launching. We'll break down the sector with an analyst on the other side, get you caught up on the latest news. Stay tuned, more market domination still to come. Starting with the 2025-2026 season, TNT will be on the bench for NBA games. It will be the first time since 1989 that the network will not be a part of NBA coverage. The league rejected Warner Brothers Discovery's efforts to match Amazon's bid for a package of games. Joining us now is Tim Nolan, Macquarie U.S. Equity Research Senior Media Tech Analyst. He downgraded the stock to neutral on the news. It's great to see you, Tim. So, this is what seems like a big blow for the company. Talk to us about what it means financially and how and whether WBD is going to be able to make that up.
Sure. Well, we don't know what the real numbers are to work with yet, but I think it's clear in our minds that the NBA was a valuable property for TNT, both for the cable network linear TV business, both in terms of advertising that it generates, and in terms of their ability to secure carriage fees with the pay TV distributors whenever those next rounds of deals come up. But actually, more importantly, in our minds, is the opportunity cost to the Max streaming service, because streaming is the present and future of TV. Warner Brothers Discovery has, in my opinion, an excellent lineup of deep quality, Warner Brothers Studio, HBO, Discovery, all sorts of programming content and sports. But without the NBA, that is their biggest piece, the most valuable piece of sports content, which will now be going away after this coming NBA season. So without that, I think it makes it harder for Max to generate subscribers and potentially to retain subscribers. So it's expensive content, and maybe it would even be a loss leader to have it. I don't know how much profit they would make from it, but to me, it was an essential property to retain, to keep, to go over for the next 11 years. And not having it is a major blow, I'd say, to advertising and the subscription fees.
And Tim, I'm just curious. I take your argument, but you look at this stock, Tim, and it's taken such a hit. It's down about 30% already this year, Tim. So I'm just curious, given the news and the stock slump, even now you look at valuation and you obviously don't think it still looks attractive, I guess.
Well, believe me, I spent a lot of time thinking and worrying about this year to date as I've seen the stock going down with a buy rating on it. And so to sort of throw in the towel here, already at $8 is not easy to do. But in my opinion, the stock is just less interesting here. Now, what could make it interesting, there has been some reputable press talking about a potential breakup of the company. The stock is arguably very cheap. We mentioned that in our note. It's trading at 6 times forward EV to EBITDA. The peer group is more like 8 times. Some stocks are higher than that. I'm just talking to direct peers like Disney, like Warner, like Fox, like Paramount. So it is arguably very cheap, and we've said that for a long time. I just think that the importance of the NBA probably cannot be understated. And therefore, it's a major blow, I'd say, to not have the NBA going forward.
What does this have any implications for their joint venture with Fox and Disney also, or is it sort of a separate issue?
Yes and no. It has perhaps some bearing on that. I mean, NBA, again, would have been an important component of that service. I think you're talking about the venue service, which is the sports JV between Fox, ESPN, and Warner and TBS TNT. So without the NBA on TNT, yes, that property looks less enticing, especially because one of the other winners of the NBA rights was actually Comcast, NBCU Peacock for the first time in many, many years. So that's content that will not be on this joint service. So look, I still think that's an interesting service. I mean, that's a very compelling combination of sports properties, in my opinion. But this is, and ESPN will have NBA rights within that. But this is, again, it's an important piece of content that will not be on TNT, will not be on Max.
Hey, Tim, if you're a viewer and you're watching this right now and you're an NBA fan, what does all this mean for you? What are the implications? Does it make it more complicated?
Well, I've heard anecdotally from consumers that they're very sad that the inside the NBA program with Barkley and Shaq and so on will not be back, or at least Barkley's not going to be back. So I've heard from consumers that's the big downside. But look, in terms of how consumers are watching TV and sports in general, even sports now is very much going over the top, as we say. It's moving on to streaming services. ESPN, we just mentioned this joint venture, but ESPN itself is going to go directly over the top a year or so from now without a cable subscription required. Max has sports, Paramount Plus has sports, Peacock increasingly has sports, especially now with the NBA. So I think as with other TV or film content that we've become accustomed to watching on streaming services, sports is now moving towards that where we got to figure out, we have to know where that game is going to be. And it's not necessarily so simple. So life as a consumer does not necessarily get easier. That's true.
Tim, I want to go back to the breakup idea for just a moment and get you out of here on this. I'm just curious how likely you think it is that is indeed going to happen. And do you think that would be the best outcome here for Warner Brothers?
Yeah, I don't know. I don't actually have a firm opinion about this. There certainly is corporate intrigue in the media sector right now, quite broadly. And maybe this would be another move. I don't know if it means unwinding the Warner Brothers and Discovery merger, which only closed 2 years ago, more than 2 years ago, or what combination that may entail. But the company has a lot of debt. The linear services are as beholden to all the legacy issues as any other network group. And so the thought process is, could we free up this really deep and valuable Warner Brothers studio, HBO, and the streaming services that people do want, and create a more valuable entity there, and perhaps leave the old pay TV business behind. I don't know what the structure looks like. I don't know what the numbers look like. I don't know what the debt schedule would look like on which side. But the argument would go that you could unlock value in that way.
God, Tim, thank you so much for joining the show today. Appreciate your time.
Thank you.
Well, wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime. We are joined by Jared Lickery to get you up to speed on the action from today's session. Let's start with where the major averages ended up, and it was a pretty swingy session, if you will, here, right? Because we did have at the beginning of the day kind of a rebound in stocks after yesterday's selling and then coming down, and that trajectory pretty much the same for all three major averages, and the Dow ended up being the only one that was in the green when all was said and done, sort of echoing what we've seen as of late, which has mostly been Dow outperformance, at least during this sort of rotation period of time. The Nasdaq, in sharp contrast, down 0.9% on the day, and it too faded more as the day went on. Actually started in the red, then went in the green, then back into the red. Same for the S&P 500, finishing down by 0.5%. The Russell 2000, though, hanging on to its gains and not really seeing much of that late day dip. The small cap seeing some buyings here, 1.6% higher. So that was an interesting phenomenon that we were watching. So maybe it doesn't seem like, Jared, the rotation trade, if you will, is dead, certainly, as of yet.
No, it's well alive right now. Let's take a look back at the board. You were just showing the Russell 2000. I want to show what the S&P 500 is doing today. And you're right, it was a swinging day. We had an upswing and a downswing. And then here's the equal weight. This did lose some steam, but it's still closing in the green. So this kind of bifurcation between the small and the big, the mega caps in the S&P 493, the small small caps versus the Nasdaq 100. That dynamic appears to be continuing. Definitely going to do a deep dive on that in about 30 minutes with Josh. In the meantime, here's energy. XLE is leading the day. That is up 1.6%. The two sectors that did the worst were the ones that were leading down yesterday, and we're both off by 4% or so. XLK, that's Tex, and XLC, that is communication services. And if I put a 2-day on, you can really see the loss is quite extensive there. Also want to take a look at the Nasdaq 100. And today, well, you're still seeing a lot of red here. Alphabet down 3%, kind of a continuation from yesterday. I could put the 2-day on here as well, and you'd see a lot of dark red. Gets kind of nasty looking. NVIDIA down 8%, Meta down 7%. But just want to take one final look. This is going to be at our leaders board. Small oil, this is, we don't look at this too often. This is Invesco S&P small cap energy. You can see it is in the middle of its range there over the last few months, kind of actually heading towards the upper end of that. That was the leader today. ITA, this is a defense and aerospace ETF. This is at a record high. Over the last few days, this is one of the few ETFs, if any, that I've seen that has been hitting record highs. So aerospace and defense has been a big source of strength. And then to the downside, predictably, stocks kind of took it on the chin here. 2 days, over the last 2 days, the Philly Semiconductor Index down 7%. Josh.
Thank you, Jared. Mixed moves for the market after Wednesday's sharp sell-off. The standouts of the session, the Dow and the Russell 2000, both finishing the day higher. And joining us now, David Sekera, Morningstar Chief U.S. Market Strategist. David, always good to see you. So the great rotation, David, it's back. The small caps finishing well in the green here. They extend this month's move, David, outpacing the SPX and the Nasdaq. What do you make of it?
Well, in my view, it's finally about time to see this rotation. We've long been advocating for investors, to rotate out of, those stocks have been getting, overvalued, overextended, specifically the growth stocks and the tech stocks, move into an overweight position in value stocks. So overall, the market, we think, is at least a couple percent overvalued at this point. I think the market can stay overvalued for, some amount of time until there's a catalyst to cause it to correct. But I do like value stocks. They trade actually at about a 7% discount to a composite of our fair values. And we also think small caps, both on an absolute and a relative basis to the overall market, also trading deep into undervalued territory. Some of those names anywhere easily a 15 to 20% discount to fair value.
We've already seen something of a sell-off. It hasn't quite gotten to a correction as of yet, David, but I'm curious what you think, what are sort of the contenders for that downward catalyst that you mentioned?
Well, it's really hard to see right now. I mean, there's a lot of different risks out there, but I look at our valuations now versus where they were in the beginning of 2022. Now, we're at similar valuations, but at the beginning of 2022, we actually were advocating to be underweight equities. At that point in time, there were really 4 main headwinds to the market at that point. And when I look at those 4 main headwinds back then, there are actually 3 of those are now tailwinds behind us. So we've got inflation moderating, we've got interest rates projected to fall further. We expect the Fed to start easing here with a cut in September and another cut in December. So really the only headwind at this point is the slowing economy. We're in the soft landing camp, so we don't see a recession. So again, I think we're in a market where it can stay overvalued, but I think the real important thing is to move into those areas that have underperformed, those areas that have negative market sentiment, that are unloved by the marketplace, and of course, really looking for those situations that are undervalued.
How, David, do you think about that big AI theme? I'm curious. After you saw Alphabet and Tesla report, it did seem like maybe some investors were perhaps rethinking that a bit, all of this expense, but show me the usage and the monetization. How, as a strategist, David, are you thinking about it?
Well, I think that big AI trade, at least here in the short term, is probably over. I'm not looking for much more, overdone market at this point. I think a lot of people are rotating out of those names. They may not necessarily be as expensive as we got to, in the dot-com bubble, but a lot of them are trading at really, really high multiples. In fact, if you look at like NVIDIA, that's trading at well over 40 times, this year's earnings. It's not until you get to 2029 that you get to, anything much more, reasonable, like a 23 times our 2029 earnings, estimates. So really, I think what we need to do is watch really the largest AI customers out there. We've got Microsoft, Amazon, Meta next week. Going to be listening really closely to what they're saying as far as their CapEx spending, what exactly they're spending their CapEx on. Now, I think it's interesting this week, Google, mentioned in their conference call that the risk to them right now isn't spending too much on AI, it's still spending too little. So we probably have at least a couple quarters of these really high growth rates yet to come. But for the most part, I think those are already priced into those stocks.
Let's talk about some of the other groups that you do like, David. One of them is real estate, and I noticed that at least the real estate group in the S&P 500 is the best performer over the last month, although year to date it's a different story. So is this a play on anticipating that we're going to see a cut to rates?
I think it's a couple of different things. I mean, one, real estate for at least well over a year at this point has been the most hated asset class on Wall Street. Now, personally, I would still steer clear of the urban office space, but I think that much negative sentiment has brought down a lot of those names relatively unfairly. So we're looking at those names that have defensive characteristics that we think look pretty undervalued at this area. So healthcare, medical offices, life sciences, research and development, those type of names. A name like HealthPeak is a 5-star rated stock, trades at a 30% discount to our fair value, has a 5.7% dividend yield. We think that's very attractive here. Ventas would be another name. That's a 4-star rated stock at over a 20% discount. 3.4% dividend yield. So I think it's a matter of not only with interest rates coming down, giving it a tailwind, I think it's just a sector that got beaten up way too much, and now people are starting to find the value there.
David, thanks for giving people a lot of ideas here as to what to look at right now. Thank you.
Thank you.
Coming up, just how will Donald Trump go about lowering energy prices if he wins the 2024 election? We'll have more on that question when Market Domination Overtime returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Cold storage real estate investment trust Lineage making its market debut, and shares gaining nicely there today. As you can see, company raising $4.4 billion in its initial public offering in what was the biggest listing of the year so far. It priced the 57 million share offering at $78, near the top of the expected range. It's also the largest IPO since ARM went public last September, Julie. So Lineage, one of the biggest, in fact, the biggest operator of cold storage warehouses, operates 482 of them all around the world, has about 13,000 customers, no surprise, most of them in food supply chain.
Yeah, and obviously we've seen a boom in things like Instacart, right, and Amazon Fresh, and people buying more groceries in that way. So that probably is part of the growth story here. And the company's done a lot of acquiring and consolidating. So that's how it's gotten to that size.
And this is it. This is what we've been waiting for. Now all those private companies are going to jump in.
Well,
this was the bellwether.
That's what all of them have been, and then it hasn't happened.
You're tired of me saying the word bellwether.
But we've heard that chatter increasing, though. That now we are going to start to see some of this pick up, but we'll see if that actually comes to fruition. Yeah. We continue to wait. As the demand for AI grows, so does the demand for data centers that make it all possible. Joining us now, Bob Clark, Clayco founder and executive chairman. His company helps build those data centers, among many, many other things. Bob, it's good to see you. Thanks for being here.
Thanks for having me.
So we have been talking a lot recently about AI, as you might imagine. We've sort of been talking about how the story's been changing a little bit, and there's still a lot of talk about data centers. There's also, however, more and more questions about how AI is going to be used eventually, not necessarily by those data providers. And I'm just wondering, demand-wise, what you're seeing on your end in terms of the pace of construction of this stuff.
Well, the pace is insane. I mean, everybody in the technology sector that is building the infrastructure, you know, these companies that used to be selling software are becoming industrial companies. They're building, you know, their CapEx is more than some of the giant car manufacturing companies. So we think of them very differently. But the demand is tremendous. I think our business has doubled in the last year on the data center side. There's two kinds of things going on. Inference, which is the digitization of everything, the back and forth with your iPhone, your questions to Siri, that sort of thing. That inference is booming. You know, we are hearing from some of our big clients, 10 times growth in 6 to 7 years is kind of standard talk. And that means that our business will double again next year on the compute side, and maybe again after that by 2026. AI is the trainer model. So this is not the computer that you interact with as much. These are the learning buildings, and the demand for that is obviously off the charts. It's taking up some of the inference. So some of the utility that's already been built is being sucked up by artificial intelligence. But I think right now the gloves are off, and everybody in the business is making massive infrastructure investments right now.
And Bob, as you build out these data centers, is activity concentrated in certain states, certain regions more than others?
Yeah, inference is really kind of wants to be close to the use. So the major cities, major metropolitan areas, pretty spread out around population centers. AI is less dependent on that. They need fiber, and you know, it used to be cheap power. Now it's just power. Where can I get power? And even the land cost is not as much of an influence. But the AI trainer model buildings can be almost anywhere.
And when we hear about these things being built, you know, we hear from the likes of NVIDIA, they can hardly make chips fast enough to go into these things.
Yeah.
From your perspective and what you're building materials, are you seeing any kind of choke points?
Limiting. Well, labor will be a limiting factor. You know, some of these jobs have 800 to 1,000 electricians on them. But I think all the technology companies are really focused on using all of the building community's resources today to start doing modular construction fab. We're using BIM modeling like we've never used it before. I think when you build a huge campus of data centers, it gives you the opportunity to build a fab facility right next to the building. And so we just have to find ways to counteract those limiting factors like labor.
And what about energy as a limiting factor? I mean, I know it's more of an issue, maybe not so much in the construction, but when the things are actually up and running. But is that an issue that you think about?
I think it will be over the time, when we're talking about 10 times and 6 or 7 or 8 years, energy today would be a limiting factor. But the technology companies are also making massive investments in clean energy and renewables, and they're really on the forefront of this movement. And it doesn't seem to be politically motivated. This is a utility market requirement, and so I think the demand will be met. And the network of utilities has been kind of inefficient. So homes are getting more efficient. There's the buildings that we're building, the advanced manufacturing buildings, are really focused on all clean energy. If you're building an electric car plant, you want to use green energy. So I think there's a lot of talk about that, but there's still a lot of capacity in the system, and I think they have to focus on transmission. They have to focus on continuing to build, and I don't think the utility companies can do things the way they've been doing them for 50 years. I think they need to modify and adapt to this new demand.
I'm curious, Bob, you're running this big construction firm. Are you able to hire all the workers you need right now?
We've been able to.
You have been.
I don't think everybody can, but I think we've been very successful. We're recruiting. I think you'll see acquisitions in our space. I think Turner just announced that they bought an engineering company yesterday. So I think the large players in our space, you're going to start seeing some M&A. You're going to start seeing a lot of activity.
I want to turn to politics finally, because you're a Democratic donor. There's a few things going on in Democratic politics.
It's been an exciting 6 weeks, really.
Yeah, it definitely has.
It's been 6 weeks.
And I know that you are trying to figure out ways to raise money for the campaign for Kamala Harris for president.
It has not been difficult.
I mean, we've seen the huge numbers. Do you think that will continue? Do you think there's going to be
I think there's a lot of excitement, and I think people are surprised, including me a little bit. I was a little bit trepid about what was going to happen on Sunday when the president said that he was going to step out of the race and focus on the last several months of his term. I think that there was a little grieving period. People were sad. I've known the president for decades, and I'm sad, but I think it was the right decision to make. And when he said that he was endorsing Kamala, I think I immediately sent an email out to all my contacts and my donors, and the excitement kind of surprised me. I got a lot of enthusiasm, and I think her reaction and the market's reaction, the financial team of the campaign responded very quickly and pivoted, and it's been energizing. There's been a lot of energy in the campaign.
As you know, there are a lot of business leaders, particularly in technology, who've come out and endorsed Donald Trump for re-election. Especially in your business, when you look at something like regulation that has been very much a focus in some Republican business circles, do you feel like those kinds of...
they're more talking points to me. I mean, I don't think regulation impacts my business. I mean, if it takes a little longer to get a permit or whatever, but what I would say is that, business is booming. Every contractor in America is busy. If they're not busy right now, they're not doing something right. So this economy has been working really, really well. We're at full employment. When labor shortage is the problem, that's not the problem. So I think Kamala will continue on with some of this really good economy that's been happening the last few years. And quite frankly, even today's news was more good news. I mean, I think the market's waiting for some bad news. Please, some bad news, but it's not been forthcoming. So I think this is the political direction that I think business people should be focused on. And I think Kamala has a great track record with the tech companies. So it'll be interesting to see if I saw Sheryl Sandberg and others have jumped on the bandwagon recently that have been a little bit on the sidelines. So I think you'll see more business people coming in on this race.
Bob, thanks for coming in.
Hey,
it's great to see
good
you.
To see you.
Always
Josh,
good to hear what's going on with your
That's
business.
great.
Appreciate it. Well, staying on the 2024 race, we're about 100 days until Election Day. One of the key issues for voters is inflation. Former President Trump gave his plan to tackle the issue of high prices in a speech at the RNC last week.
I will end the devastating inflation crisis immediately, bring down interest rates, and lower the cost of energy. We will drill, baby, drill.
But just how can he go about lowering energy prices? Joining us now on this, Yahoo Finance senior markets reporter Inez Ferry. Inez, energy energy production, oil and gas production, has gone up under President Biden. So what does with this plan look like?
It's at a record under the Biden administration. So drill, baby, drill. Will energy companies, will oil and gas companies want to drill more than what they're already drilling? And that's really the question. And can Trump persuade these companies to drill more? So look, I've talked to a slew of analysts about this. The consensus is that right now, energy companies are focused on two things. One is capital discipline, and the other one is returning cash to shareholders through the form of dividends and share buybacks. That's their focus. If it gets too unprofitable to drill, then they will not keep drilling. So once the profitability starts declining, you will see less and less drilling. And you have a slew of consolidation that has happened in the energy space. So they really have a lot more say as an overall group as to how much it is produced. Look, if we take a look at where we were at during the Trump administration and during the Biden administration, when it comes to the energy space, Trump's XLE was down more than 50% during the Trump administration. Of course, you had the lockdowns, you had the pandemic, you had oil going sub-zero during that administration. Then when you are looking at the Biden administration, you're looking at the war in Ukraine. So energy prices spiked and you had the reopening. So XLE actually soared more than 200% during the Biden administration. But the bottom line is that these analysts are all saying you are going to see a lot more deregulation, a lot more leniency if Trump gets elected towards drilling on federal lands. So all of that red tape will be taken out. But I just got off the phone with somebody from an energy investment firm that said the red tapes would be out. However, you still have market forces that are going to come into play. So if it's not profitable, they won't drill more. And you also have really an oil market that is global. So you have OPEC Plus to contend with one analyst telling me you probably will see Trump going to ask these nations, the OPEC nations, to output more if he does get elected.
Well, we'll see what ends up happening, Inez. Thank you.
Thank you.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere on the other side of the break. It's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of that curve. Here are some of the trends we're going to be diving into. Back and forth, the Nasdaq and S&P 500 struggled to hold on to gains in today's session. Rotation appears to be in full effect, with the Russell 2000 gaining more than 1%, but big tech names extending declines in today's trade. Alphabet, Nvidia, and Meta all ending the day lower. And tech is not the only sector hurting. Autos feeling a pain after a string of weak earnings. Ford missed expectations. Stellantis' CEO called the company's first half disappointing. We take a deeper dive straight ahead. Plus, the 2024 race has a new look with Harris versus Trump. Policies are being closely watched from Wall Street to Silicon Valley. We'll speak with a venture capitalist later in the hour about what's at stake for startups this November. Now, the auto industry is stalling this earnings season. Top automakers posting disappointing results spark uncertainty for the sector. Stellantis reporting profit fell nearly 50% in the first half of the year compared to a year ago. Ford shares had their worst day since 2008 after that company missed earnings expectations. And joining me now to talk about all this is Kevin Roberts, CarGurus Director of Industry Insights and Analytics. Kevin, it is good to see you. So, we had a number of companies, give us the latest and greatest earnings reports. Kevin, is Ford. We heard from GM and Stellantis. It's a lot for investors to kind of digest, Kevin. As you look through these reports, you listen to the conference calls. What were your big takeaways, Kevin? Just how healthy, how strong is that industry right now?
So I think the auto industry as a whole is still quite healthy, but we're seeing consumers who were revenge spending over the past couple of years, coming out of COVID with the stimulus funds going out, and then we had the semiconductor chip shortage, really kind of shook up the overall market and pushed prices really, really high. And I think we're in a bit of a rebalancing right now, and that's really what we're feeling and starting to see this earnings season.
Let's dig in a little more into some of the segments. EVs, for example, Kevin. I think a lot of folks were wondering, had we hit the trough and better times ahead? Is that what you heard when you looked through these reports?
So I think you're still seeing automakers kind of rebalance their expectations and product plans in the face of there was expectations that you're going to see a lot more robust EV demand out there than what is actually shown up. And now we're seeing a situation where dealer lots are really starting to overflow with EVs. The day supply of new EVs for the middle of June was around 137 days compared to a national average of all vehicles at 83. So there's definitely supply and demand imbalance right now. And I think you're starting to see the industry start to work through that and also start to come to grips that I think their plan was really to start making more luxury EVs and put EVs into kind of larger, more profitable pickup trucks and SUVs, which also means you have to put the largest batteries in those vehicles, and consumers really just aren't seeing the appetite for them. And so you're also starting to hear automakers start to say, we might need to start making more lower priced EVs, maybe smaller EVs, CUVs, that might get you more volume to really see EV overall adoption take off.
What do you think, Kevin? Obviously, we've got an election here, and some folks are trying to game out, let's say Trump, Vance take the White House, what that could mean for the EV market. How do you think about that?
I think when it comes to the election, probably the most kind of stark lines you're seeing out there right now is related to EV policy. Overall, econ policy is still a little too early to say what could be going on. But at this point, I really think the industry really is in on EVs, and that probably is the long-term trend of where it's going. The question really is what the adoption rate curve is going to be.
How about hybrids, Kevin? Still hot?
Really hot. If we're talking about the amount of day supply for EVs being really high, hybrids is actually below the national average. And still, if you're looking for a hybrid, it's going to be much more difficult to find those out in the marketplace right now, really seeing their kind of opportunity in 2024.
All right, we talked EVs, we talked hybrids. Before we got to let you go, the big three's bread and butter, trucks, Kevin. How's that looking? Healthy?
There's still healthy demand for them, but the demand for the kind of those higher priced trims maybe is pulling back a little bit as consumers are, dealing with higher interest rates. So still healthy demand. You're still going to see a lot of those large full-size pickup trucks and even mid-size pickup trucks being sold, but consumers might be looking for more affordable trims within there. than the higher price trims that they were really indulging in over the past couple of years.
All right, Kevin, always good to see you. Thanks so much for joining the show. Appreciate it.
Pleasure.
The Nasdaq and the S&P 500 struggling to hold on to gains in today's trade, extending declines for a third straight day. And joining me now with today's takeaways, Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. Well, we got to take a look at the damage that was done before we can assess what's next. And this is a post-mortem here. So let's just take a picture of what happened over the last 2 days. This is the Nasdaq 100, and this is fairly ugly. I've seen worse, but this is fairly ugly. NVIDIA down 8%. Alphabet also down 8%, Meta down 7%. And if we take a look at some of the indices, and we can look at the Nasdaq or what have you, let me just pull up the Nasdaq here, which was down another 0.9% today. But if we look at the 2-day, here's what I want to show, is that on the open this morning, that's when the low was in for most of these markets. So you take a look at the Nasdaq, low was in at the morning here. S&P 500, I'm a little worried because we came right back down, kind of closed at the lows there. And then the Dow, which closed in the green, up about 0.2%. That is still down over the last 1 or 2 days. But I take a look at this, and I was kind of talking about this with Julie earlier, that when you take into consideration all the selling that we saw yesterday, well, now we're seeing rotation again, and maybe it's not as bad as it seemed.
So I'm a trader, and I'm listening though to this. I
Yes.
want to know, Jared, tell me, is the selling over? Is this just a pause?
I'll tell you what I'm looking at. That's a great question because the VIX is pointing to the potential for this to be over, like as though this is already done. So here we have the VIX spikes. Whenever we get a VIX spike, and this is a year-to-date chart, we see stocks fall off a bit. What you're going to notice is this spike right here, not quite as big as this one. And in fact, if I put a 3-year chart on, you're going to see the spikes keep getting smaller, smaller, smaller. That means the selling intensity has been getting less, less, and less. If and when the VIX pokes above this line, and it might be tomorrow, it might be in a few weeks, that's when I get more concerned about a protracted sell-off, but not right now.
All right.
All right, so we move on to number 2 here.
Point number 2.
Let us go.
There we
Small
go.
cap rotation.
Yeah.
You can't, the small cap's kind of saving the day here. I said the Dow was in the green here, but small caps were up 1%, and they were just flying a few days ago. Let me show the Russell 2000 here. This is a 3-year chart, and I'm going to leave it here. I like this because it shows there's just been a lot of choppiness here. And you see every time it tends to peak above, well, guess what? Sometimes it's a bit of a disappointment. So we've seen a lot of fake outs by the Russell 2000 over the last few years. Now, I'm going to shorten this time frame to a year to date. This really stands out. That is impressive. That tells me this thing wants to go. But, something could stop it.
Have we seen this movie before? Do small caps get kneecapped?
Yeah, I think I go back to this 3-year chart, and we've seen small caps get kneecapped so many times here, fake breakouts to the upside and the downside. I'm a little bit weary, but I do take the strength of this move, and I'll go back to this year-to-date chart. I look at the strength of the move. This thing wants to go up.
Right. It's so quick and aggressive, that move. Amazing. All right, third one.
Third one, we got to take a look at the yen.
Yeah.
Japan is capitulating.
Okay.
I've been looking at not only the yen, but also the Nikkei stock index. Now, I think we were talking about the Nikkei when the dollar was at its high. That was 162 yen per dollar. And then I'm going to show you where it is now because it's all the way back to 152 or thereabouts. And here we have the US dollar versus Japanese yen. So 162, that was the highest, I think, in 35, 40 years. And now suddenly we are about 6% off. 6% doesn't sound like a lot, but in currency terms, it is a lot. And then I'm going to show you what's happened to the Nikkei. This is their benchmark stock index. It's down 3% today. And let's just go over the last 10 days because over the last 7 of these, it is down 10%. And so this is something you don't usually see. The Nikkei was actually in a greater position, higher returns than the Nasdaq this year. And so it's under a bit of pressure. Why does this matter?
Yes, this is my point. So let's say you're my dad. You're Andrew Lipton.
All right.
He's probably watching right now as we speak. Andrew's wondering, this is fascinating. Why does it matter to me, Jared?
All right.
Bring it home.
I'll tell you what, Japan is always the last to lower rates. They're always the first, or excuse me, they're the last to raise rates and they're the first to cut rates. And so what we see happen is we see these wild moves in the Japanese markets when we're at inflection points. That could mean that we're on the precipice of a bear market or that the Federal Reserve is about to change the business cycle here. I'm not suggesting that we are right at that moment right here, but this is how these things begin. So we got to keep an eye on the yen because one of the things in finance is called the carry trade. That's where all these traders are borrowing low in Japan. Then they're deploying those assets overseas. When that unwinds, you see this huge shift back into the yen. It disrupts global risk markets, and that's why we're talking about it, because we got to watch those canaries. Japan is one, and it's flashing yellow. Not orange, not red, but yellow.
All right, yellow flag. Thank you.
All right.
Buddy. Appreciate it. Up next, how investors are looking at the 2024 race. We're speaking with a top venture capital investor. Next, on what the regulatory backdrop could look like. More asking for a trend right on the other side.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Come November, the regulatory landscape for startups and big business alike could look a lot different, depending on who, of course, wins the White House. We're taking a closer look at how smaller names are navigating this uncertainty. And joining me now is Jordan Knopf, Tusk Venture Partners co-founder and managing partner. Jordan, it's good to see you.
Hey, thanks for having me.
So maybe, Jordan, just to start, just kind of big picture here. When you look at the overall venture industry, tell me what you're seeing. How would you describe it? What are the kind of the big themes and trends?
Yeah, the big theme right now is definitely the lack of liquidity. So the lack of exits, whether that's IPOs or M&A transactions, has really kind of locked up the entire ecosystem. So that is the number one thing that people are focused on, whether they're limited partners that are investing in venture funds, whether they're startup founders that get money from venture funds, or GPs of the funds themselves.
Why aren't we seeing more IPOs, by the way? What are the reasons for that?
So interest rates plays a major role. In addition, the perception that there's not much demand in the market for new listings. Also, just the threshold that you need to hit from a revenue perspective and the underlying unit economics and the economics of the business itself are kind of up for debate, what it takes for a successful IPO.
Do you see that kind of shifting 6-12 months out?
It could be. The interest rates obviously play a major role there. That most likely will be different. The investor sentiment and the appetite in the market, I think, there's a few more variables at play there. It'll also be interesting to see if the M&A market picks up or not. That makes up the bulk of exits.
And we were talking off camera about that. Right now, obviously, I think if you're big tech, you know that the trust busters in Washington are looking much more closely. Could that change? I mean, if you do see a change in the White House, if Trump and Vance take the White House, is the expectation okay that could change things up here?
I think the expectation, at least from venture capital investors like myself, is that a new administration will likely bring a new head to the FTC and potentially a different posture that the FTC takes with antitrust specifically. If you can ease up the fear that is essentially growing in the ecosystem in general around the fact that big tech just does not want to transact right now. It really takes a lot of the wind out of the sails in terms of how you can underwrite a deal to an exit.
It's interesting though, because we were talking, Jordan, about how you kind of try, as an investor, you try to gauge, okay, if Trump-Vance wins the White House, because Vance, as we were talking about, he has nice things to say about Lena Khan, but your counterpoint, which is well taken, is Trump obviously is the one who sets the economic policy at the end of the day.
I think so. Yeah.
And what? Let me ask you this: what if it's Harris? Then what? Does that change the calculus?
So it doesn't really change the calculus for types of investments that we're making, or really how we underwrite a deal. I think that it's interesting because I think that probably has more implications down ticket and from a state and local level, which actually, from a regulatory perspective, most regulation in technology happens at the state and local level. So it's a little bit, it's hard to say with a Democrat or a Republican in net at the state and local level what would the best outcome be. I do think that professional investors, particularly early stage fund managers, definitely think that life was better whenever Trump was in office last time compared to whenever Biden was in office or is in office, and therefore they're kind of voting with their pocketbook.
Interesting. You're a venture investor. You're talking to a lot of smart entrepreneurs and founders. What are some of the big themes and trends, Jordan, that are interesting to you right now?
So I'd say that there's obviously AI that continues to be on the forefront.
Is AI among venture investors, is the interest as intense right now as it was 6 months ago, 12 months ago?
It's all relative, I think. So interest probably is about the same. Now, volume is very different. I think that now we're seeing a lot of deals getting done. We're seeing a lot of activity not in the AI space, which really was just dominating any deal that was happening. It's interesting because you have AI as within part of healthcare, or AI as part of fintech. Is it an AI company or is it a healthcare business? And that's kind of up for debate. So I think that all companies are implementing some form of AI strategy into their businesses at this point. So it's just a kind of a new framework to use.
Jordan, I wish we had more time. Such a fascinating conversation, but thanks for joining us. Appreciate it.
Thanks for having me.
Okay. Time now for what to watch. Friday, July 26th, starting off on the economy. Big piece of economic data on deck tomorrow. Personal consumption expenditures data, PCE, the Fed's preferred inflation gauge, out at 8:30 a.m. Eastern. Economists forecasting both overall PCE and core PCE to tick up slightly. The new June print will give more insight into the Fed's path to a rate cut ahead of next week's Fed meeting. Then on the earnings front, we'll be getting reporting from Bristol-Myers Squibb, Colgate-Palmolive, and 3M are the top names to watch. Dow component 3M posting second quarter results ahead of the open. Analysts expecting the company's organic sales to take a hit with weakness in the consumer business. And finally, the summer box office is heating up. We've already seen movies like Inside Out 2 and Twisters bring in big numbers. Now, Deadpool and Wolverine is out tomorrow nationwide. The new Marvel movie is expected to bring in between $160 to $170 million domestically. Stick around, more Asking for a Trend on the other side.
Welcome to Stocks in Translation.
I'm almost always of the school that you buy high, sell higher.
Our essential conversation cutting through the hyperboles.
When the horse gets out of the barn, you have to go chase it.
The market mayhem.
You know, are you bullish or are you bearish? What is your target?
And the noisy numbers.
Don't fight Papa Dow.
Time now for our word of the day. This episode happens to be brought to us by the number 2. Eddie, who is wearing the DeFi mantra better? Is it Solana or Cardano? To give you the information you need for your portfolio.
There are a lot of ways to invest where you don't have to extend yourself and try to hit that home run.
You're going to find that technology was a leader and an outperformer in pretty much every single one of them.
Do we get the follow-on participation?
That's the big question, and maybe Jay Powell will help us with the little rate cut.
Watch Stocks in Translation here on Yahoo Finance at noon on Tuesdays and Thursdays, and listen to us on Apple, Spotify, iHeartRadio, or wherever you get your podcasts.
Factory construction is booming in the U.S., spurred by federal programs. That's the subject of our chart of the day. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Josh, as you know, we just got GDP numbers for the second quarter today that came in better than estimated with growth of 2.8%. And as part of that, we also got more insight into factory construction. Now, this chart coming to us courtesy of George Perks from Bespoke Invest. He's the one who pointed it out that we are seeing this huge surge in factory construction as a share of GDP. In fact, that figure is now at a record as a percentage of GDP. Some of this has to do with the CHIPS Act, some of it has to do with the IRA, and basically a lot of the fiscal stimulus that has been put into the economy to try to get this stuff built. Now, as George pointed out in an email to me, he said basically this looks at investment as it takes place. So in other words, you have initial site prep in some cases. Sometimes that's the most expensive part of the process, he says. It's unclear how long that this trajectory will last. He says we're not seeing equipment investment pick up next, which presumably would be kind of the next phase of this. But we did talk to Savita Subramanian earlier from Bank of America about this sort of infrastructure boom that we are seeing. And she talked about whether she thinks that it continuing will hinge on the election.
But I think the idea is if cities want to court all of these new businesses and new jobs and economic activity, they need to make sure they have the infrastructure in place to support that. And I think that is necessitating and maybe hastening an infrastructure spending cycle that is, kind of, as you put it, agnostic of who wins the election, government spending, fiscal spending.
So in other words, she doesn't think that who wins in the presidential election will matter much for infrastructure spending. And as you know, we just had a conversation with Bob Clark of the construction giant Clayco. And it sounds like whether he's building data centers or helping build some of these factories as well, things are going gangbusters.
Yeah, he sounded very bullish, Julie. So you mapped out the big trend there. Any ways to play it?
Yeah, well, Savita talked sort of in the very big picture of buying into infrastructure building type names. From George Perks, again, over at Bespoke, he gave us some specific examples of companies where this might work. These are various companies that are in construction. We're looking at the year-to-date chart. So you can see in most cases, these stocks have already gone up quite a bit. We're looking at MCOR up 61%. Some of these are Canadian-based, by the way, but they've seen big increases as well. Stantec is this one that's up 11%. We've got Atkins Realis up about 33%. So already a lot of these names have been going up, but he says companies like these, like Nasdaq, like ACOM, should continue to benefit as we see this boom. Most of these guys provide either services, construction, project management type services, or in some cases, some of the materials as well around these construction projects.
All right, thank you, Julie. Now let's take a look at what's trending here after hours. Shares of Skechers, they are rising higher following a mixed earnings report. Footwear company beating estimates on the bottom line, while net sales of $2.16 billion came in below street expectations. Company also raising, though, its full year guidance and announcing a new $1 billion share repurchase program. Sticking with shoes, Deckers Outdoor shares getting a boost after the company's fiscal first quarter results beat estimates and raised its profit outlook. The company's incoming CEO giving a shout out to brands Hoka and UGG for their fantastic performance during the quarter in the release. And Norfolk Southern shares, they're jumping after hours after the company reported sales rising for the first time in 5 quarters. The rail giant topping second quarter earnings estimates, while revenue came in line with Wall Street's expectations. Rising revenue is a sign the company's turnaround plan is starting to take hold. And L3 Harris edging lower. It's after raising revenue, margin, and EPS guidance for the full year. The aerospace and defense company topped expectations for adjusted earnings per share in its second quarter with revenue of $5.3 billion. That came in line with estimates for the period. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.